but it's really become much more of a global issue, and it's hitting, into the emerging economies quite hard, and the inflationary impact of it is really hitting the global economy. So everyone's paying the price for this, including the Russian people and from the sanctions that they're dealing with. But so I want to talk about it from a couple different perspectives today, but I really want to start by talking about these five, to me, big paradigm shifts that we see going on right now. And each of them in and of itself would have a major impact on how you approach your investment strategy. But taken together, it requires, to me, a major rethink of how you're positioning portfolios, how you're thinking about asset allocation, how you think about valuations in this market. So the five are the switch from a highly easy, historically easy monetary scenario to a very rapidly tightening one. That we're seeing massive slowing growth in Europe, the US, and China. Three major economies accounting for over 50% of GDP means we are likely moving to a global recession. How difficult that'll be is highly uncertain given the lack of knowledge of how the war will end and when it will end. I think another major shift stemming from the war, but also going back for several years, back to the Trump administration, is this switch of that started, basically 30, 40 years ago, of globalization really taking off, and we're moving into a highly globalized, integrated system to one that is now becoming highly fragmented and will line up along trading blocks. I think there's a major change that has big implications. I think the energy transition is the other big one that's going on right now, but it's not moving the way it was originally thought it would move. And now it's more of a fossil and renewables to get to renewables. And as a result of all these things, a shift in the global economy from a more deflation-prone economy with four big forces: globalization, demographics, debt, and innovation, really driving a very deflationary-prone economy. And now several of those forces, except for innovation, have switched to a negative, and that's moving us to a more inflation-prone economy. And I think that's really what's the setup is behind how you think about investing in this environment. So let's get back to the price of the war and what it's done. I think you can see it hitting us in two big areas that are leading to a lot of weakening in business confidence and consumer confidence. On the left-hand chart, you see the downshift in PMI, which is a reflection of an economy that was in a high growth mode with massive stimulus to one with a lot of headwinds coming, and you're seeing it move into below 50 as contractionary. And you can see the dip in consumer confidence, and particularly how dramatic the European consumer confidence has dropped. And those changes really weigh on economic activity, because as confidence drops, people bring in the oars and then they don't spend as much at a time we really need to keep economic activity moving along. You've also seen a big move in rates, and we've moved up almost 300 basis points in short rates around the world. You've seen that in the US. Europe has seen a big change. Germany went from, I think, minus 59 at the low on the 10-year Bund up to now closing in on 2%. So big changes in a very short period of time. That's putting people in an inverted yield curve potential, and that is a historic indicator for recessions, as you can see from the charts of the four major economies. Switching gears here to labor markets, we've had some of the tightest labor markets we've had around the world, and they do remain tight, which is creating a big concern. And one of the big remnants of inflationary pressures right now is really the big focus is the labor market, and are we going into a wage price spiral? What you can see from this chart is what the range has been since 2002 of high to low in unemployment rates. And you can see how tight the labor markets have been in most of the world. And yet that's the gray bar is the high to low. And then you can see Q2 2022. And what you can see here is we are going to get out of this. We're going to have labor markets get hit and unemployment rates go up because of the tightening conditions. And I think that's the debate that's going on right now is the strength of the economy from the stimulus that's been put in over the last couple of years has created very favorable conditions for companies to hire and bring people on. That reverse that we're seeing right now and the shift that's coming because of the war and because of the inflationary pressures is actually putting labor markets into a position where they're going to be reversing. And how fast that takes is really one of the big challenges to get inflation under control. Here's the real price of the war, and it's really being borne by the Europeans. And you can see that in gas and electricity, where you're looking at tenfold increases in many cases for a lot of the population in terms of energy costs, which is leading governments to look at all different ways that they can manage this with price caps and other things. But the cost of that for governments is going to be massive. And it's coming at a time that they don't really have the bandwidth to do this, where they can do it on a sustainable basis. And it really needs to be done in a highly targeted fashion, which is not always politically supported by the broad base. So that leads to bigger challenges for governments to how do you do the right thing and keep in power. That's actually one of the big rubs that's going on today and one of the big challenges. This just gives you a sense, and this is a chart, Mark, we've talked about this a lot, but what is energy as a percent of GDP for some of the leading OECD nations? And you can see here in the blue bar is what the average energy expenditures were in terms of GDP for 2019 to 2021 and where it is today. And you can see from Italy's case, from basically 5 up to 13%, all the way to the US, where we were running about 3% going up to 6%. So these doublings of cost are really punishing consumers and households, and it hurts those least fortunate the most. And I think that's one of the challenges we're going to see. This is a really interesting chart to give you a sense of how big an impact it is going to have on the GDP of these nations. And you can see that borne through in the inflation numbers. And this is a chart that shows inflation as they take a basket of inflation basket and look at what the combined is. And as you can see, all trending up pretty dramatically in a very short period of time. That's something we're going to have to keep an eye on. And then it leads to a much more slowing of global growth and a reversal that is really, you can see from the blue line was where the outlook was in December. And from the red line, as you can see, the September outlook. And it's a big downshift in growth, almost 1% or more in some cases. And that is going to have a significant impact on individual economies, even worse than the downshift was expected coming out of the highly stimulated economy we had last year. And it's not going to fall that fast, even though it is coming down. And we believe that we are moving closer to peak inflation overall. A lot of that depends on how the war progresses and how it ends. But as you can see, what the 2022 projection was, and then where you see it going for 23 in the red, and it's not coming down enough. And remember that a lot of central banks had a target of 2% as their inflation target. So you can see how far off we are from that number. The 2% number is actually kind of a made up number. It's really was designed for central banks to have a target that keeps them far enough away from deflationary forces. They have to move off zero, but not too high that you can't sustain it with average growth. So they came up to about a 2 or 3% number, which ironically was a number that the New Zealand central bank used when they first were starting inflation targeting, and that came out of a research paper. So it's not as scientific approach, that 2% level, which is why people are suggesting it may need to move up. But it gives you a sense of where we are relative to those targets, and we are not close in most nations, other than Japan, which has had trouble getting inflation up for 30 years. This is another chart that looks at demand reductions that are required to avoid hitting those low gas levels. And Mark, as we found out when we were in Europe last week, it's not clear what the gas storage levels mean based on the forward outlook, because so much of it depends on so many other changes. How cold will the winter be? What other sources are able to step in and fill the Russian decline in gas supplies, what other issues are coming. But the red dotted line is the threshold for risk for heightened supply disruptions, and that's at the 30% level. And as you can see, we're as you move out into the spring, the issues become much more challenging. And I think from the discussions that Michael and others were having on the 10:30 call, I think this is where part of the strain is coming from and why the uncertainty is so high as to how this plays out in Europe. One of my concerns is because of the war, because of the supply chain issues, and because of the increased cost on the industrial sector for Europe, that some of the European sectors are going to really be hurt pretty badly, and they happen to be some of the stronger ones. So it's the manufacturing, the metals, machinery, those issues you can see are in a really bad spot here, potentially from a forced supply reductions or forced supply reductions in usage that would create greater strains. And I worry about this, how Europe gets through this, but it's coming at a time that we're reorienting supply chains to be closer, safer, and more secure. And what does that mean for the viability longer term? Do they take a hit? Is it temporary? Is it more of a structural change? Is a question that I have no answers, but it's a concern that I think if it goes on too long, you could see shifting away from Germany, which is one of its strongest areas. Does it change the dynamic, or does it just reset with the Western world versus the autocratic world moving forward? So this is really the impact. Gas shortages are going to hit growth and inflation. You can see some of the numbers here and what it means. It's obviously lower growth, higher inflation, bad setup for governments who are trying to deal with populations that have big needs. And they're going to be doing this against higher bills with wages not going up as much, and the desire of central banks to kill inflation will likely lead to a loss of jobs, and that puts greater strains on the system. So it says we're going to have a tough period as we get through this, and that means central banks are going to continue their tightening initiatives. They've done massive policy tightening. You can see here how it's changed. On the left is the US, Europe, and the UK. On the right is some of the emerging economies. And I think the strains that are coming out of the stronger dollar and the higher interest rate setup means there's a revaluation of assets and values that we need to really think through. And the equity markets and some of the other markets have gone through that reset pretty quickly. And you can see in the public markets being down 25% or so. But you are seeing it in rate moves. You're seeing it in a lot of areas, and we're starting to see it in the private markets as well. So what does this mean for us, and how do you think about investing in this environment? And obviously, Mark, as you had highlighted, the concerns out of our conference in Europe was high. Cash is a big issue. I think the uncertainty is having people pulling the oars at a time. For us as longer term investors and not traders, we see this as a real opportunity, and we see the revaluation of securities creating some massive opportunities for people to invest. But when we step back and think about securities valuation at ARS, we start with three things: the outlook for interest rates, the outlook for inflation, the outlook for corporate profits. We think that inflation is starting to peak. Interest rates will move up a little bit more so the central banks can kill off the inflationary concerns that they have. That's the goal. They're trying to reset the market's mindset that they are on top of it after being viewed as falling behind. But we think the other shoe to drop is the corporate earnings, which have held up remarkably well. But now that we're having higher interest rates, higher inflation pressures, and a stronger dollar, we think for a lot of multinationals, the earnings numbers have not come down quite enough yet to reflect the time where it is all safe, all clear to go back in. But we do see massive valuation creation coming, and a lot of the key areas, and some of them that are the secular drivers for the markets, like chips and other areas that we've been very positive on. But until we get to the level of inflation and interest rates where we get them to peak, we're not going to be able to really go whole hog in investing into the markets right now. But we do see opportunities that are worth taking advantage of right now. And the negative sentiment around the market gives us even more confidence that we're getting closer to the time to take advantage of those opportunities. I think the challenge we're going to see, and you're seeing this in the reaction to policies out of the UK, a lot of nervousness about what are the new policies going to be out of the new government in Italy is policymakers don't have the same wherewithal that they've had for a long time to step in and support the economy and to create growth. So they're going to have to be very targeted and very specific about what they do, or they're going to run the risk of not being able to control their currencies and have this currency free falls that we have going on, which makes it kind of a very difficult environment, particularly when most commodities trade in dollars. Makes it very hard for these policymakers to come up with the right decisions. We're definitely going to have higher unemployment. This changing rate structure, I think we're going through this valuation reset. It still has some more to go. I think other classes outside the public markets, which are valued every day, are going to see their valuations start to come down a little bit more and a little bit more aggressively. But I think we're setting up for an environment where if you have the right assets in the secular themes, you can make a lot of money because some of the valuations are being quite attractive. So for us, those secular themes are electrification, digitalization, national security, which is going to attract a lot more spend, essential industrial commodities, and special situations where companies are, without the help of the markets, able to either, because they're massive cash flows, buy back significant amounts of their shares that will retire shares of their company at a rate of anywhere from 15 to 30% a year, which create a great investment opportunity. So I think the war is going to weigh on us for some time. There is a lot of uncertainty whether how Europe holds together in terms of the fight against Putin is who wins the war of waiting. I think that's really the big issue right now. And how far is Mr. Putin willing to go to win a war or to stay in power is the uncertainty that comes with it. But for us, we are starting to take advantage of these pullbacks and see some really interesting opportunities where single-digit multiples with really good earnings potential are available to investors right now. So we think this is a time to take advantage of that. So I'm going to stop, Mark, and open up for comments and discussion.
Stephen, question regarding the secular and the investment themes, special situations. Can you elaborate on that?
Yeah, there are always companies that are in a position because of they either have price inelasticity that allows them to manage through this because they're the only game in town. That puts them in a unique position. That's one of the things that those companies do particularly well in inflationary environments. There are certain industries or certain areas that tend to do particularly well in inflationary environments you want to take advantage of. But the other one is we have 5 companies in our flagship strategy, which is only a 30 stock portfolio, that have the opportunity to buy back between 20 and 30% of their shares a year for the next several years. So regardless of really how much growth they have, their cash flows are so strong that they can retire those share counts, which just sets up for a really interesting scenario. There's also those companies that have the opportunity to split up to create value because they were well conceived, or not as well conceived as the strategy originally to put them all together. But in the breakups, you can see some real significant value creation, particularly if one of the areas that they're in or two of the areas that they're in are new secular themes going forward. So, we have a Flextronics, which, for example, plays in both the chips and also in the renewable energy space. So they can win 2 different ways with their business. So they can split up, and they're also a big share buyback company as well. So those are some of the examples of special situations that we're focused on.
Thank you, Stephen.
You really want to win that award, Adam, for the first question at the end of the year.
Well, I don't have Rob here.
But he could come on strong the last few months. Other questions, comments? John Denniston, good to see you. Go Blue.
Good to see you, Mark. Stephen,
John.
fantastic as always. Stephen, let me ask you a question, which relates to the supply of workers in America, and even with higher interest rates and resulting in somewhat higher unemployment. It seems to me that's a secular long-term challenge for the country and economic growth. And I'd love to hear your reflections on that.
We have had a significant problem, which we have an easy solution for, except for our politicians. We're a country built on immigration throughout our brief history, and yet we're now fighting to keep people out of our country that want to be here. And the debate in Washington, D.C. is about all the wrong things on that. We have a demographic cliff. We have a birth death rate that is falling behind. The economy is going to make it more difficult for people to start families now economically. So the solution for it is a much stronger immigration policy. And our friends to the north, we could follow their lead. Canada has a great immigration policy. They benefit hugely from our mistakes in immigration. And if I had the ability, I would open up our borders to having between 500 and 1 million immigrants come in a year.
I'm with you, and that's not happening, and doesn't appear to be there. It's a third rail of politics, and so if you just take that as a given for the next 5 years, hopefully it changes. I mean, the implication for the American economy is dire. Yes.
Well, it is, unless we really get after substituting capital for labor the way we've talked about for years, and you're seeing it pick up now. I would expect robotics will be a massive part of the manufacturing and even retail segments of our economy going forward. I think you'll see a carve out of white collar jobs that will come along with that, because you don't need the same oversight for a robot as you need for a staff of people. And I think you're already seeing it in China. I think China last year had purchased 250,000 robots to put into their manufacturing system, and that number is expected to ramp up dramatically. So I think you will see much greater use of robotics, much greater use of digital process automation, and we need a new immigration policy for skilled labor coming in. And we need to stop the debate that we're having about what we do with the people that are here. They're here. We should move on from that and figure out how we get the best and the brightest to come back to the U.S. as they used to, because that's going the other way.
Stephen, to that, you've been talking about this so long. What I think we should do an event around immigration. Let's. I'm not trying to be political, but let's just educate. See where we can find the common ground there. I did see it, Michael Hammer. You had your hand up. Just one thing. It came to my. Anyway, go, Michael. You go ahead. I have a comment later.
Okay. I was just going to respond to what you're saying, Stephen. And I am an advocate of immigration reform, don't get me wrong. But when if the US changes its immigration policy, the impact on the countries where the immigrants come from, if a doctor comes from another country or an engineer, it has a very large impact on their economies. So in a way, it appears to be a beggar thy neighbor sort of situation.
I'm sorry, Michael. I'm very John Locke on this. It's a free market. Then they need to change their own internal policies. I think people vote with their feet. They did that through Europe for a long time.
Fair enough. I'm just pointing out that there are global implications.
Without question, and but those people are gonna leave anyway. They're usually leaving for a reason, because they want a better life. So if you're the area that can provide the better life, then why not? I think that's really part of what our leaders should be looking for. How do we get the best for our country first, and how do we do the best for the world second? And that's just that's the self-interest that they each have to work from to get reelected or stay in office or do the right thing. But this is clearly an issue of, where the people are is not where they want to be right now. And and their prospects there to achieve what they want to achieve aren't always as good. So I think this is a question of, you're right, it'll hurt a lot of nations, but a lot of those nations that people are leaving from have either overpopulation versus their resources or other issues that are forcing them out. So I think it's a real issue that we need a lot more thoughtful discussion. I don't have the right policy, but I just know that we have the wrong one.
How
Stephen.
about that run for the borders, right? In Russia?
Yeah.
Very interesting.
Guys, I'll say like,
Chun-Mi?
sure. I mean, I'll say like, you
Name
know,
one.
are y'all able to hear me?
Yes.
Yeah, go ahead.
I've benefited from the fortune of great immigration policy. I think my parents immigrated from India a year before I was born, and to y'all's point, you know, and I certainly understand the need to regulate our borders and make sure that we are getting the best and the brightest. But at the same time, it's been sad to see over the last few years, folks like my parents are getting turned away more and more. I played tennis at the University of Georgia. My teammates who'd worked at great corporations for a number of years ended up not getting their visas renewed. They were sent back to South Africa, Germany, wherever it might be, after working in banking for a number of years, just because they couldn't keep going. And so, I mean, to both sides, certainly need to control our borders, but there's undoubtedly something that's going wrong where we have guys who come to college here, work for a number of years here. They can't be getting sent home 5-6 years in. And so, you know, like I said, I totally agree with both sides, but definitely think there's a lot of improvement to do to continue holding our place as the best country on the planet.
You're speaking reasonably. Our politics don't allow for that right now. So maybe we can try to throw healthy lights. Wanda, do you want to make a comment?
Yes, as an immigrant, I'd like to change the topic, if I may, and leave the big discussion for your event. Stephen, in these conditions, how do you see the trend for Web3? NFTs were, you know, reached the pinnacle before Putin's war. How this new asset class will develop, how it will be impacted by these conditions?
I think there's someone better on the call, almost anyone better on the call to answer that than me. I just think the current conditions will force us to promote much greater innovation, much greater push for digitalization. How it impacts some of those as investment opportunities, I'm not really sure, to be honest with you, Wanda. So I'll open it up, Mark, to people with more knowledge on Web 3.0 and particularly on those areas than I.
Thank you.
Well, I guess your secular themes do talk about digitalization.
Yep. Yeah, well, money has to flow there to lower cost in everywhere. But when you get into NFTs and things like that, I don't know how they're gonna be affected.
I guess I don't know. Jump in real quick. Wanda, I think that kind of the whole higher rate structure, clearly higher hurdle rates, you know, for new companies. I think VCs are going to have to be a little bit more circumspect about, you know, who they're funding and what they're funding, things like that. So I could see, you know, just because of the overall tightening of everything, that it's going to be a clampdown. It's not profound stuff, but at the same time, the potential in that space is just so huge, and I think that there's so much interest at the founder level that you're still going to be seeing a lot of stuff going on. It's just that I think those projects that are going to wind up more funded, it'll just be more discriminating. Anyway, also, Stephen, if I could segue and ask a question, I just saw the headline, and you guys were there.
Bill, can you just pause for a second? I wanted to show a picture. It'll take a moment. And this gives me hope right here. If I can. All right. So this is at our Wiesbaden event. This guy, Marcus Furman, he was the founder of Delivery Hero across Europe, and he is now bringing digitalization to a new level. Is that German let's say efficiency to construction and a few other industries and another young next gens. So it's very, this is what does give me hope, and I'd be curious that we're going to be tracking some of these developments. But go ahead and carry on with your thought.
Yeah, no, sorry. Yeah, absolutely agree. If I may segue one more, and you guys were over there, what do you think of and I just saw the headline, the tax cuts in the UK? Very, from a policy standpoint, really, really interesting. What do you think about that? I mean, I think it could be real. I'd love to see it succeed, but what do you guys think?
Well, we've had some unusual policy approaches, starting with Turkey lowering rates to fight inflation last week again. But I think on the UK one, it's going to be interesting because this is the classic economic battle back to Laffer, right? Can the Reagan and Thatcher approach work again in this environment? I'm not sure. But it is an aggressive approach. I worry, is it going to leave, with all the other issues of the UK, is it going to leave them worse off coming out of it than they get the short-term gain from the break? So it's a tough one, Bill. I'm not sure how to think about it just yet.
Anyone want to carry the Brit bullish case?
I'll give you my 2 cents. I think it's the UK and the central bank there, it feels like they've had an eye on the currency crisis, that when Soros made a pile of money betting against the pound, they've operated in fear of that ever happening again for like 40 years. Watching them through the financial crisis, they oftentimes were kind of a leading central bank in raising rates. That was kind of my observation. I think it's fascinating how they just said, screw it, we don't care anymore. I mean, it's wild. I agree with Stephen, though. I don't know if it's going to work or not, but it's pretty interesting to see him saying, all right, we're off that. Pound crashed, and they don't seem to care that much.
Yeah.
Anyone else?
It's such an interesting thing because, the Fed and other central banks are using demand destruction as, such a blunt instrument to try to win this inflation battle. And I think the causes, the more particular causes are elsewhere than just excess demand, for that. So, as a way of kind of easing the inflation hit on the British people, it's, I don't know.
Bill, what I worry about coming out the other side is, so they cut taxes, should give their companies a better opportunity to compete. But what industry is going to really benefit because of the cut taxes that can lead the UK into the future and be their kind of corporate champion industry that's going to drive them forward in the global environment we're in today? Is the question I have. How do you get the sustainable long-term benefits as opposed to the short-term sugar high?
Yeah. No,
Well, we talked about that, right? We talked about they need to diversify. There is a reshoring happening. They tout that they were the first with the with vaccines and some of the other innovations. Again, giving the bullish camp. I think it's, and then some say that after the financial center, diluted and then is regrouping. Who else is going to take that role across Europe? And people again are marching with their feet. But Mirjana, you're in London. You have any?
Yeah, I
Right.
just shared from UK government website the facts about tax reduction. And one thing that is obvious, people who earn quite low income, who are on low income, are going to suffer the most, as always, when something like this happens. And again, those ones who earn the most, they will benefit. So I don't really understand the reasoning behind it. In these fact sheet that you just shared, there are some reasonings that make sense theoretically, but in practice, how who will attract and how UK will attract higher income people to move in and start their businesses and whatever. I don't really know. Let's see. But the bottom line is, I was just listening Piers Morgan and Evan's breakfast show yesterday morning about this, and they're obviously both massive earners, and they both said it doesn't make sense. Why do we have to actually pay less taxes when millions of people will actually suffer from it? So I don't really understand why is this happening, and yeah, it's in the moment when energy crisis is really hitting every household. It doesn't matter of the income, but again, people with the low income are already suffering big time.
But who knows? People think the grass is greener on the side.
David Lane, I'll mute you if you wanted to let me know.
So
Anyone?
I don't know, lots of things in the UK right now that we don't know where this and how this will span out, but hopefully for the best, especially now announcement about startups who are raising SEIS. We talked about it in London funding. So there are benefits for there were benefits for investors to invest, and there was a cap to 150K. But now that has been extended to 250K. So for startups means that they can benefit more from investors who are looking to invest in less risky way, let's say. So and benefit from tax returns. So that's a good point. So there are things that are good, but again, lots that we'll see.
The tax policy aside, I think it always comes down to these ecosystems on venture. That was a theme in the London. Germany just doesn't have the ecosystem. They've got great tech out of their universities. They just can't do much with it. And Berlin is unique. There's been a 20-year cycle. It's starting to fashion itself. England, you got your pockets, government supply of those tax credits. It helps. But there's something, innovation. Chinese just throw tons of money. They figure it out. Yeah, I was so earlier today we're talking about Europe like not being a driver, but yet war is bringing the Europeans to be a little more innovative. They're also changing their labor structures a bit, so it's reshuffling the cards. But it all does come down to ecosystems and building bridges. Rob?
Hey, Mark. Yeah, I just had a quick question on that trip to Europe and Germany. How mentally affected do you think the German business community was with the Russia position on the energy flow there?
Well, others can speak to it. I'm happy to. I mean, it's an issue. I was surprised that they think they can get through the winter. It's the spring. That's when they're depleted. And they've been green. I'll let John speak to it, but they've been green, but they gave up nuclear. They wish they could keep a little bit of nuclear, and they're getting floating LNG terminals moving. They're trying to pivot. But if Putin says, "I want to switch you off," Volkswagen and chemicals industries, there's next spring. That's their worry. Sorry, John, you want to comment on that?
Yeah, a couple things for you or Stephen or anybody else. It seems to me there may be two fundamental differences between Reaganomics and Trustonomics. The first relates to the dollar was strengthening at the time of Reaganomics. And so the tax cuts were inflationary, but the stronger dollar was deflationary to some degree, offsetting. And the opposite is occurring in Britain now, which is the tax cuts will be inflationary, but the pretty rapid decline of the pound is also inflationary. And so that's going to put pressure, I think, on the Bank of England to tighten and increase interest rates, which will to some degree offset the supply side gain from the tax cuts. But again, interested in others. The second difference is there's a fundamental demographic difference where Britain has a similar dynamic to America, just aging with immigration restrictions and so forth. And at the time of Reaganomics, there was a huge boost to the economy from women coming into the labor force in a way they hadn't previously. And so you had this wonderful new supply of labor that really pushed the supply side effort. But I'll stop there and let Stephen and others smarter than me comment on those.
Yeah, it's interesting. I think the question I have for these policies, particularly the ones that every country's putting in now, is, and then what, right? When you get to the other side and you've, cut taxes, what is the outcome that you're going to get that's going to make it a sustainable change in the business as opposed to a temporary one? Because one of the things the OECD report was highlighting is that they think the fiscal support should be targeted and temporary, that we've created too much of a reliance on governments out into the future, and then we don't get anything back for the spend. So one of the concerns I would have is for the UK government is, okay, after we do this, how are we better for it other than people have paid lower tax and we hope we get more economic activity? But that's not strategic. That's almost a wish. And so I wonder what industry is going to benefit, what's going to drive the economy forward so that they now have a national champion to count on to push the economy forward. And I think that's the worry about all this spend, is we make it permanent and get no gain, no structural gain from it. So I think that's the issue. I don't have the answer to it because they don't, the one pagers that they put out on why don't actually give you the long-term benefits and what it means economically long-term. And even, we just saw this with the cut on student loans. The CBO came out with a report that says it could cost $400 billion, but they can't really tell because they don't know how many people wouldn't have paid their debt back and all that. So they can make the numbers dance. I just think there's no real strategy behind what most of these countries are doing. And without a strategy, then it's just throwing money at a problem that you're going to get subpar results from. So that's the worry I have for the spend on UK and really the spend anywhere right now.
Others?
Well, Stephen, apologies that I wasn't in on the 10:30 conversation earlier, but while you guys were over there, did anyone talk about potential immediate actions, such as North Sea oil, gas fields, things like that, to try to alleviate some of the energy pressures?
So
it was interesting, Mark. I think I just jump in. I was surprised that they were talking about it, but not as quick to reverse some of the policies that they put in place around fossil fuels in particular, and nuclear. There's talk about it. They're doing some, but you would have thought they could do more faster to offset the problem, but apparently they're not.
So again, I wish we had recorded that event in Frankfurt Airport, but it was really good discussion between Christoph von Oldenburg, Michael Spett, other Germans, and Simon Vine. And Christoph really set the table well. He was talking to your question, Bill. He was talking about nuclear. They think they can maybe keep a couple, but maybe they've lost the skill sets to operate some of those. They think it was a big mistake in hindsight. Of course, the whole Nord Stream was a big mistake. The floating LNG terminals are part of the solution. I don't have the capacities on that. I think it's more of a problem for southern Germany and southern Europe than northern, because they do have the ability to pipe or otherwise move it in. But we are going to have, so Christoph is coming over here in about a month or so. And we're gonna have hopefully by that time, Stephen, your office is open.
Yep.
Your new offices. And we'll have that discussion sort of with their insights. And it's country by country and region by region. I mean, the good news is they are 50% green. But bad news is that their chemicals industry relies on Russian gas.
I have another question, and I want to ask you, how did you find the attitudes towards Ukrainian migrants or Russian migrants? Is Europe getting tired of all those war stories, or they are still embracing people? What were the sentiments?
Well, we heard there let's say breaks in the armor.
And I'm sorry, I should say refugees, not migrants. There's a big difference. So refugees.
Well, certainly Paula Schwartz here was speaking about refugees, but Christoph pointed out that the eastern part of Germany, there are these nationalist sentiments that are rising with inflation and who they're going to point fingers at. So there's that, and that's something to be, contended. I don't know if anybody else that was there could speak to that. I don't know, Michael or Eddie or Stephen.
I asked the question earlier when the war started, Mark, and the issue of migrants this time versus the Syrian war was there were Europeans that were coming in as opposed to non-Europeans, and I thought that was an interesting take back then. I think the problem with immigration policies are they're poorly articulated, and people worry about them most when the economies are suffering.
Okay.
And that's the worst time to be bringing people in because they feel like they're taking their jobs and taking money away from them, as opposed to doing it when things are good. So I think this is one of those periods, and we're doing it against a backdrop of high national sentiment rising because of the war. So I think it creates a dilemma that the longer this goes on, Wanda, I suspect the less open people will be.
I know that Italy happened just recently, last weekend, but did you sense an undercurrent of that nationalism, Italy and Turkey? Turkey, or I should say Hungary.
Hungary. No, I don't know, Stephen, others. I didn't, from the crowd we were with, there were a few outliers that were saying some strange things. I think they were more talking about what is happening and could happen, but I didn't hear any anti-refugee sentiment. And then anyone else wants to comment?
In fairness, Mark, the crowd we were with would be least impacted by
I know. I know. I mean, they were aware, there was awareness of it, but that was not coming from that crowd.
No.
Thanks.
I mean, this is a 361 crowd mostly, right? So we're
Mark, I have a question for you. I think it was you that said this earlier before the briefing, that you had a sense from the group that the war is over there in the back. Can you elaborate on that? Or is this coming from younger people or executives? Or I find that really amazing.
I mean, Stephen, you probably are the best person because this is sort of one of your takeaways.
Yeah, I went over thinking Europe's at war, and it didn't feel like Europe was at war. It felt like the Ukraine's at war, and the other people have an economic issue. Was kind of and that's an oversimplification, but I went expecting that we're going into a war, a region at war, and it was not the action or reaction.
But I would counterpoint that I heard many Europeans and Brits like I mean, I don't name names exactly, but that they have to completely stop Putin.
Yeah.
And I heard that sentiment many times, but I think there are some others. I also think it might be stylistic the way people talk about things. Americans, we're a little hyperbolic, and Germans are just, let's get down to business, and yeah, we're at war. Let's get our LNG terminals floating and moving, and we'll fix it. But that could be just me, Stephen.
Come join our 361 Firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.